Guys can't hear me or you want me to like re-say something, just let me know. But yeah, nice to meet all of you. I'm Tina. I guess I'm a student at McGill University. I study finance there, but right now I'm in Sydney, Australia, doing an exchange semester. So Josh, who I used to intern with last year at Ontario Teachers in Toronto, he like basically pulled me out of my beach enjoyment headspace and he told me that I had to come talk about finance. So here we are. Yeah, what I was doing at OTPP was within the capital markets department, we have like an external managers team, which basically writes checks to different hedge fund managers. And so I did learn about portfolio construction and management, like in the sense of like a bunch of hedge funds operating within a portfolio. And so thought I could speak to that a bit more today. And yeah, when I come back to Toronto in August of this year, I'm going to be starting full time at BlackRock, doing investor relations. So I guess that job also would fall into like discussions of portfolios, this time just like different clients' portfolios and helping them reach their investment objectives. So yeah, that's what we're going to talk about today. Portfolio construction, the way I thought about it was, oh, you can go back. That's fine. It's
Right.
just like thinking about risk and return and how does that like work through different assets to help you meet your own objectives. And I don't want to get too technical with like the details. I did throw in a couple formulas just to like show you where you could like get started with it. Josh told me that you guys like are trying to build a trading bot or like running some like quant strategies, and that's like a project you're going to be doing throughout the year or the term. So hopefully these ideas can help you guys like think about portfolio management like holistically, think about your risks, and just have like a systematic way to put it all together. So yeah. Um, Next slide. Any questions? We all good? Okay. Yeah, why is this important? I mean, like you can have a really good trading strategy that generates so much alpha, but if you don't consider like, correlation between your different strategies or like what the underlying factors like your assets are exposed to, like things that you would consider in like a proper portfolio construction process, you risk just, getting wiped out. Working with hedge funds, like obviously you hear all the time about like funds blowing up. Like, for example, long-term capital management. This is in the 90s. There's a really good book about it called When Genius Failed. Like the guys who were running this hedge fund were like the inventors of the Black-Scholes like option pricing model, and they still, like overlooked some risks relating to like I think it was government like debt and like default. And so because they were so levered and they were taking these risky bets, like blew up so much that they had to be bailed out. So not that like we as students are going to be reaching like those levels of crises, but just to say that like even the experts, need to think about proper portfolio construction. And in the industry now, like that's become a big focus alongside like risk management. Um, but yeah, you move to the next slide. This is just like summarizing overall.
One second. Jake's got a question. I'm gonna try and move you a little
Yeah.
further.
If you want to read it to her as well, you can. So what is the alpha that's being generated in that bus mean?
What is the alpha being generated in
That bus, like what does that mean on the train?
on the train? Yeah, I mean, have you guys like talked about like alpha and like beta?
No, not yet.
Oh shit. Okay.
That's fine.
Wait, I have to define it off the top of my head. Like beta is like your exposure to like the market, right? So let's say your strategy, you're trying to beat the S&P, and the S&P is like returning 10% over the time period. Your strategy returned 12%. Your alpha is 2%. It's like the excess above like what your benchmark is, maybe. And so even though you're like kind of eking out these extra returns, let's say like you just had like an idea or like you picked something that the market had mispriced, like that's your alpha. Like that's like the smart thing that like you're trading on, you're making money on. Even though you have ideas that like have alpha, if you don't think about like how it kind of works together in your portfolio, because different assets can like have relationships to each other as well. then you risk like wiping out all the alpha that you like worked so hard to generate. Does that make sense?
Save it. Yeah, sorry, go on.
Okay, cool. Yeah. Let's move to the overview. Wait, oh my God. Now let me know, Josh, if some of this like is maybe too much. That's fine.
Oh, it's fine.
So yeah, I put everything into like three like buckets of how I would think about it if you were to like cook a portfolio from scratch. The three big things would be first, you have to figure out what your investment objective is and if you're working with any constraints. So like your return target, your risk target, or what we call like volatility, if you're tracking against any benchmarks. And then of course you have to consider your investable universe. So what asset classes are you investing in? What sectors? What like themes are you trying to follow? And then finally, it's sizing because your portfolio is just a collection of different like bets or like trades or assets that you're holding. And so how are you going to decide like how much money or capital to give to each of them? As well, like for each trade, like how big are you going to let each trade become? Let's say it's doing really well or it's underperforming. Like, do you have like kind of guardrails to say, oh, like when it hits this level, we're gonna like take profit or we're gonna exit. So that's the first part. The second part would be actually like using data to select your strategy and then optimizing your portfolio. So we talk in the industry about exposures, both to like macroeconomic as well as style factors. We'll get into all this in more detail one by one. But yeah, just like to give you guys an idea of what we're gonna go through. The other thing would be back testing. So like how do you actually evaluate whether like a strategy you want to put on is like robust? You can use like historical return streams. You can consider like these are kind of statistical things of like if you put all the returns on a distribution, what does the tail look like? What is like the worst case scenario? And then finally, there's like optimization of like different strategies within the portfolio. There's like the mean variance approach, which you'll probably learn in your finance class. There's also one that they use in the industry called risk parity, which is like equal weight through volatility, as well as like correlation matrices, and then of course like all the capital market assumptions that go into that. So all that gets put into like your portfolio, and then once you kind of have that running, you have to think about how you're managing your portfolio on a go-forward basis. So how are you executing your trades? Like, do you have to consider transaction costs, rebalancing a portfolio, like liquidity, and then of course, like always evaluating how your portfolio is doing. So either performance against your benchmark, there's other ratios like the Sharpe ratio, and then of course like stress testing, like putting your portfolio through scenarios, say like, oh, if COVID were to happen again, how would each asset that I'm holding move and how would that affect my like profit and loss? So yeah, I know that was like a lot, but I put it all on the slide so you guys could like have it and you can like always refer back to it as, you know, like Quant Club progresses and you guys keep like adding to your knowledge. So yeah. Josh, does that sound good?
Yeah, no,
I can get into each chunk now.
yeah.
Cool. Yeah, just to like illustrate for you guys what this might look like, right? Your investment objective. Again, like to go back to the trading bot that you guys would be designing, it could be interesting to like clarify what exactly your target is. Like obviously everyone wants to make money in the market, but having like a specific goal can help you really narrow down like your investable universe and the strategies you're going to employ. So let's say like you have an equity fund, right? You want to beat like a composite index of the S&P 500 and like the Toronto Stock Exchange, the TSX, by let's say 1% a year. And you want to have your maximum volatility to be 15% or lower, so within that band. So that's like a clear objective where you can then like use data as your portfolio kind of moves throughout time to evaluate like how you're tracking. And it's not just like, yeah, I want to make like X amount of money. Well, actually, that is also like an objective you could do. You could work in like dollar terms, but yeah, that's just one way to like define what you're doing. The next thing is the investable universe. So obviously there's so many different financial assets that like you could invest in. And you're going to have maybe like an interest towards certain ones over others or like expertise in certain assets over the others. So equities is usually like a good place to start. Let's say this fictional fund is going to only invest in mid to large cap US and Canadian equities. cap, or that is just like the market cap of the company. Like we're only going to invest in ones that are like larger and not like the penny stocks. And we're going to do, let's say, all sectors except for energy, because investing in energy is taking a lot of like macro bets on commodity markets. So let's say you're going to look at all companies in like the consumer financials, tech, media and telecom, TMT, industrials, healthcare, and materials. And let's say that you're going to go long, but you can also go short. And then finally, sizing. So this example here is like on a volatility basis, but you could also think of it just like dollar value. Like let's say your portfolio is like $1 million. You don't want any single trade to be over 5%. And so like you always have like a constraint on like how big each individual position can get. And that's just maybe for like diversification purposes. You don't want one thing to like be the largest driver and kind of like mute out everything else. But yeah, does that all kind of make sense?
Some guys got a question. Alan, go on.
Could you explain what shorting is?
Yeah, so shorting is like taking a bet like against an asset. So let's say a stock, like it can either go like up or down, right? To go long means that you would make money when the stock goes up. To go short means you would make money when it goes down. Because like a trade, there's always like two sides. And so sometimes people can short companies where they think, like let's say there's like fraud. Like Silicon Valley Bank, when it collapsed, like you could short that, things like that, where it's just like another way to express your view on the market. We don't always believe that things are gonna like grow or like improve over time.
Yeah, perfect. Thank you.
Yeah. Okay, there's math now. Yeah, so now we're moving on to point two. First thing to talk about would just be exposures and thinking about what exactly your assets are like being driven by, if you like. So even though we've split like assets by like type, like for example, a stock versus a bond, or like, oh, this is a consumer stock versus like a financial stock, they can still have like the same factor exposure. And what these factors are, on the macroeconomic side, it could be things like inflation, the real interest rate, credit, liquidity, like GDP growth, or just like emerging markets. And so you can think about like, even though two stocks might be in different sectors, or you're investing in, let's say, like a consumer stock, but also like an ETF of something else. Like they could both still have exposure to inflation. And so like when inflation goes up, like maybe those two assets that you're holding, like they're gonna move in a way that's related. And so it's important to understand like the underlying factor exposure. And then the other thing would be style factors. And this is stuff you might see if you learn like Fama French models. For individual stocks specifically, there's factors such as value, momentum. Carry, I think, is more, it's less of an equity specific one, but there's like, yeah, minimum volatility and like quality. I don't want to get too much into it, but like, again, this is a starting point. Google like factor analysis. And there's going to be so much literature on this, like academic things, industry primers, YouTube videos. Like it's good to familiarize yourself with like what the industry thinks are like underlying drivers within their investments. And then how you would measure that, like back to our alpha beta discussion, like the way you actually calculate that would be through like a linear regression. And so you can do that same thing with all these factors. So it's just like statistics. Yeah. So once you kind of have an understanding of like exposures driving your portfolio, the other thing would be to then like put your trades through some more rigorous like data-driven analysis. And so yeah, we talked about long versus short. Let's say like you want to do like a trade in your trading bot, and it's going to be a pairs trade. So instead of just going long one asset, you're going to also short something else and kind of like take the difference because you think, how do I explain this? So yeah, let's say you have like one like tech company and you think that's going to like outperform relative to like the other tech companies, right? But you don't want to be exposed to like the overall like tech sub industry going up and down. You just want to take a bet. Like your alpha, your idea is like that specific company is going to outperform its peers. So one way you can hedge that idea in practice is to go long that tech company, but then at the same time, you're going to short all the other tech companies, right? So you're hedging out that like tech industry exposure. And the way you could do that is through like an exchange traded fund, which is just like an index of like all the funds, sorry, the companies in that industry. So you long one leg, you short the other leg. And then you're going to want to figure out like, is this actually like a good idea to do this trade? One way to do that is to just look at historical data, like how would this trade have performed in the past? So let's say like, how do you figure out how much money to allocate to each leg? One way is through volatility weighting. So you would assume that like the individual company probably has more volatility, right? Compared to the ETF where because it's a bunch of companies put together, there's some like diversification, it's going to be less volatile. So you're going to allocate more money in dollar terms on your trade to the short end to match the kind of volatility of the long end of that single company. So that's how you would like calculate, okay, like the size of your trade. And then let's say you're going to rebalance. So like over time, as like, you know, the prices of the assets change, you're going to have to sell or like buy more of each component to keep that ratio, to like keep that like volatility relationship that you've defined. So let's say you're going to do all that. What you can do is you then, if you have like historical daily return data, which you can pull from Bloomberg, you then have like a return stream of like your trade, and you can do some like statistical analysis on it. You can calculate what the expected return, which is like the R equals P over like P minus 1. You could also calculate the volatility, which is like the square root of the standard deviation of the return stream. And you can do that over different periods of time, which is like the historical like back testing component. So just through these like basic analyses that you can, you know, run in Excel even, you have an idea of like, yeah, what would be the return in the vol of your strategy during like different periods in the past, during maybe like more crisis periods, like when tech stocks just tanked like a couple years ago. And those are just ways to like evaluate your strategy before you just put it into the portfolio and think like, oh, this is a good idea, like let's just do it. So yeah, more like objective analysis. And actually, like this, we actually did all the capital markets interns. I don't know if you were doing this, Josh, but we had like a paper portfolio that we were running throughout the summer.
Yeah.
And this was one of the like analyses that my manager recommended that I do on a trade that was similar to this one. So, yeah,
That's perfect. Next slide.
cool. Okay, this looks like kind of icky, but this is literally just from ChatGPT. Like you can get this too very easily now. But yeah, let's say you like, I don't know, you split up your club, like you're gonna work in teams and every smaller team's gonna come up with some trade strategies. You come up with maybe like 10 total, right? Now you have to figure out as like a team with your trading bot, like how are you going to actually put that into a portfolio? How much weight or like money are you going to allocate to each strategy, right? In a way that makes sense. Here's what we start doing. Here's where we start doing portfolio optimization. And so the first one, mean variance, it's just like an optimization problem where you're solving for like one constraint given like another constraint, right? So here it could be like, I want max expected return given a certain level of risk. And this can go back to, remember in part one where we said we have to define like our investment objective. So then you optimize according to that objective. And all the inputs here, you basically just need like the return streams or what you think the return streams are for the different strategies that you're running, which we calculated previously. Because then you would have, you know, your expected return and your vol, and then you would be able to run like correlation like between different strategies. And then putting that all together, you will then back out like the weights that you would give each asset. Yeah, again, like just at a high level, that's what the idea is. You can go through like the algebra on your own. This is something that's taught, I think, in most like finance classes if you are in the finance stream. If not, like it's on ChatGPT, Wikipedia, like any finance textbook, YouTube videos. It's yeah, it's a pretty classic like finance or yeah, financial like approach to portfolio optimization. Yeah, and then the other thing would just be if you wanted to do like risk parity, the next step would just be to set like each contribution in vol terms equal to each other. But yeah,
Yeah,
that's how you would think about optimizing. And you would use data that you then like generated through your back testing or your research. And again, like keep in mind, this is all like assumptions based, right? There's gonna be so many like pitfalls as well of like using historical data. Like we never know what the market is gonna look like in the future. Sometimes the assets you want to trade like weren't around until recently, so you don't even have the data. But again, like these are just ways to create like a more robust analysis. Yeah, the correlation that I was talking about, this is an example at the top of like a correlation matrix. So you just kind of like cross two assets against each other, and then the number will tell you like the degree to which like they're related in their movements. So if like two assets are perfectly correlated, one, right? Then let's say if something goes up 10%, the other one's going to also go up 10%. And then you can kind of like infer from there. This is also, I think, based on like historical data, or it's like yeah, assumptions. So like take it with a grain of salt, but that's how like the inputs look. The other thing would be like capital market assumptions, which is just like published by a lot of different like investment managers and like bank like research arms. So I think this one is from BlackRock. But like there's so many like experts out there who are trying to forecast like, oh, in the next like 5 years, we expect I don't know, European equities to have like a return of like this and of all of that. And so this data is like also out there. And if you're not sure, like, oh, I'm not the expert on like forecasting every single asset class because they're complicated, there are like information sources out there that you can use as like a jumping off point to put into like your calculations and your models.
awesome.
Yeah.
Any questions about that?
Yeah, I had a question.
Go for it.
Mhm.
So my question was, what goes into forecasting an entire geography of equities? How does like a analyst go about that?
Good question. I would assume there's a lot of like macro and like region specific analysis that goes into it. Like usually when people are trying to forecast, yeah, they want to like go from like bottom up and look at all the components, right? So like you have to think about again the factors, like what drives like equity markets, and then decomposing those factors, like what drives those factors. Like if a factor is like economic growth for equities, what are the inputs into economic growth? Like maybe they have to look into like production, like in industry and everything in each region and kind of like sum that up. So again, like even the experts, like there's no like one right way to do it. Otherwise, like somebody would just be consistently making money in the markets all the time. But like using as much like objective like data as you can and like creating logical assumptions from that is how you would be able to like feel comfortable with the assumptions that you're making. Does that make sense?
Yeah, perfect. Thank you.
Okay. All right, no more formulas. Thank God. Yeah, the thing about portfolio management, you guys will be trading like a paper account, I'm assuming, right? Josh, there's no like real money in this.
We're actually thinking of throwing like $100 at it and seeing what happens.
Okay, yeah.
Real
That
quick.
makes it more fun, more skin in the game.
Yeah.
Yeah, when you're actually trading, like if you have like your own account, you'll know that there's like additional costs, like paying like a commission to your broker. If you're trading on leverage, which basically means like you don't actually put down the full amount and you're kind of like borrowing to like magnify your returns, you have to maintain like a minimum like level of like capital, which is your margin. So like that is a cost when you're trying to trade in large volumes. And then also you have to think about like, selling positions, buying new positions, and like the continuous rebalancing of your portfolio to again like fit those constraints that you set. So there's a lot of like operational effort that goes into managing a portfolio. And that's like a whole other topic. But if you don't control those costs, you kind of get like, your perfect portfolio in theory, and then you have like the execution in practice, and they can have like a big difference. So in like the funds, like they'll have entire teams like in operations, like doing this and like trading for you to like optimize it. And then finally, evaluation. How do you know if you're actually doing well? We spoke about benchmarking in the beginning, right? We had this fictional fund that was benchmarked against like the US and Canadian equity markets. And so one way to like evaluate yourself is just to see like, okay, how much did that index make? How much is our fund making in that same amount of time? Like, why is it differing? Like, are we actually doing better? Are we doing worse? And like, why? The other things would be performance ratios. So like Sharp, for example, is like, I think return over volatility, or just like dividing different stats that you have in your portfolio by each other. And those also like give you an idea of like performance. Um, Drawdown and peak to trough, these are like more like hedge fundy metrics, but drawdown is just like from the top of like the performance to like the very bottom, like what was that like drop in percentage terms? And then also like how long did it take for you to like recover from like your worst? Things like that, just to like evaluate. Finally, the stress testing is running like scenarios or simulations on your portfolio. I think you could probably do this in Python if you guys have like coding backgrounds. Um, and yeah, that's just like, hey, if different factors move or like a geopolitical event happens, what would be the like movements on my individual positions? And then once you aggregate that back to the portfolio level, like how much could I hypothetically like make or lose? So just like asking yourself these questions, that can keep you, sharp with like everything that's going on with like all the assets you're holding. Because it gets complicated very quickly. Like if you only have one trade, fine. But then the second you have more than one, there's like interactions between everything, and there must be like ways to analyze it all. So yeah. Any questions on this part?
Okay, I think we're good.
Nice. That was it for me. I wanted to keep it short. There was this like really good book though on hedge fund strategy specifically, but I sent the PDF to Josh, so he either like already sent it out or he will.
Yeah,
Um,
that's already.
yeah, it speaks to like the ratios that I was talking about, the different drivers, the different trades, yeah, and like performance evaluation. And there's also a lot of interviews with like really famous hedge fund managers on like their investment philosophies and like how they made their money. So that's like a engaging way to get into it as well. I was recommended that book like when I started my internship, and it really helped me. And then yeah, just thank you guys so much for listening. Feel free to like add me or write me on LinkedIn, or if you want to email me, like happy to talk more about questions you had from this, or if you want to learn about like my different internships or just finance in general, like happy to talk to you guys anytime. Okay.
Okay, thank you so much, Tina, again. And just touching on the points Tina just mentioned, she, for example, spoke about like an investable universe. That's actually today's task, right? So we're going to be given a lot of data is going to be thrown at you, which includes stuff like Sharp ratios, drawdowns. You just want everyone to kind of have a conversation about what each of these things actually mean, things you might potentially consider. We're working to get the data to you, but soon, like all the data you can possibly imagine for every financial instrument. But stuff like Sharp, drawdown, volatility, etc., should be made available to you by the end of the session. So for example, Tina also spoke about pairs trading. If you remember, Keegan actually explained that last session, right? So if you paid attention to the last session, you understand exactly what she was talking about when she's talking about pairs trading. Then again, we're going to split it up into teams, and we're going to start working on optimization around, volatility and some of the other features for the rest of today's session. So thank you again, Tina. We don't want to keep you any longer, but very, very much appreciated. Give another round of applause, guys.
Oh, thanks, Josh. And that sounds like a really good session. You guys are lucky that you guys are doing such interesting work. Like I don't even think McGill has like a club like this. So enjoy, and I hope you guys learn a lot. I'm gonna go to the beach now. No, I'm kidding. I have to go to class. It's like 8:30 here. Yeah. Bye guys. Have a good one.
You.
Cheers.